Look at your portfolio right now, because the software sector is absolute carnage. Salesforce stock has been completely cut in half from its peak. Adobe is down 40% from its high, and it is ugly. Workday, Snowflake, MongoDB, OTA. They are all bleeding out on the pavement. The entire software as a service sector has just been taken out behind the woodshed and beaten 5 years ago. Back around 2021, these were the untouchable market darlings. You literally could not buy them because they were so ridiculously expensive. And today, they are being tossed to the absolute side of the road. Like yesterday, Trash Wall Street is completely convinced that artificial intelligence is about to finish them off for good. So here's exactly what I want you to consider right now. When Mr. Market panics this loudly about this many massive companies all at once, he is doing one of two things. He is either correctly pricing in a literal death sentence for an entire industry, or he is handing long-term independent investors the absolute investment opportunity of a decade in this video. I am going to show you the exact single question that separates these two scenarios, and I am going to walk you through a real example trading today, where the numbers are frankly hard to believe. So let us stop complaining about our portfolios, and let us actually talk about it like adults. Now, before we touch a single individual stock, you need to understand something most retail investors get totally wrong. Listen to your older brother on this one, because not all sell-offs are created equal. You guys, there are 3 completely different kinds of market sell-offs, and they each demand a completely different emotional and strategic response from you. Type number 1 is a company-specific sell-off where things go wrong internally. Management blows a massive strategic decision, growth stalls out completely, or some financial fraud surfaces. What happens is the stock price drops, and that drop is usually fully deserved. It is deserved because the underlying business is actually significantly worse than it was yesterday. For the long-term, type number 2 is a broad market-wide sell-off driven by macro factors. Interest rates spike out of nowhere, a major regional bank fails, liquidity evaporates, and everything gets repriced at once. So the good businesses, the bad businesses, the ugly businesses, they all go down together. And these exact chaotic moments are what Warren Buffett literally lives for. They live for it because great companies go on deep sale right alongside the absolute junk. Type number 3 is the exact one we are trapped in right now, which is an industry-wide sell-off, not just one single company, not the whole entire stock market, but one entire specific industry is repriced. Simultaneously, this happens because of a massive, terrifying shift in the collective story of that specific industry sell-offs. In my personal opinion, are the most fundamentally misunderstood events in the entire world of investing. Why are they so misunderstood by everyday retail investors? Because in the absolute dead middle of them, the market completely stops being precise about the actual value of these businesses. Uncertainty is running completely rampant, and short-term institutional investors on Wall Street cannot yet tell the winners from the losers. So, what do? Because they are terrified of losing their annual bonuses, they just panic and dump every single thing in the sector. Without looking at the balance sheet, they dump the absolute best companies. With massive cash flows, they dump the absolute worst companies that were already dying anyway. Every single ticker symbol is treated exactly the same by the algorithms. And that complete lack of precision from Wall Street is exactly where the generational opportunity lives. Right there, that is precisely where the massive gap between current price and intrinsic value can blow wide open in the best businesses. But you absolutely have to know exactly what to look for, or you will lose your shirt. So right now, software and tech are absolute ground zero. For this mass panic, artificial intelligence has created a massive wave of existential uncertainty across every single software as a service business on Earth. Retail investors and analysts are asking, will artificial intelligence completely replace this software product? Will corporate pricing models completely collapse into zero? Will revenue growth flatline forever? Because of open-source artificial intelligence tools, and rather than answer those incredibly complex questions carefully, one single company at a time, the market is just selling everything. So, here's the one critical question. The exact one I promised you up top. This question will tell you whether each of these fallen software stocks is a dangerous value trap or a hidden treasure. Is this specific technological disruption structural, temporary, or completely irrational? Now, please understand that making that distinction is absolutely everything in this game. Structural disruption means that the long-term earning power of this business is permanently lower. Going forward, the competitive moat is completely broken, and the core product is going to be replaced by something better and cheaper. So think about Kodak. When digital photography arrived on the scene, you probably do not even remember Kodak because you are too young. But when digital cameras arrived, that was not a dip in fortunes. That was an absolute funeral for their entire business model. It was a permanent structural change in how humans capture images. And when that happens, Mr. Market is 100% right to punish the stock price, and a cheap stock price today will look incredibly expensive a year from now. As that company continues to decline to zero temporary disruption, means the market fear is incredibly real, but the underlying competitive moat is actually fully intact. In other words, company revenue and net earnings will take a temporary bruise, but then they are going to recover completely. The resilient company will come out the other side of the crisis even stronger, while weaker competitors go bankrupt. So think, for example, about Texas Roadhouse during the 2020 global pandemic panic. These physical restaurants were legally forced to close down completely and their revenue disappeared. Overnight, the stock absolutely cratered down to $35, as people thought casual dining was dead forever. But anyone who actually understood their incredible brand moat made an absolute fortune as the stock rocketed from $35 to $200. Now, the third category is an irrational sell-off, which means Mr. Market fear is based on a purely emotional reaction to something new. Netflix stock famously tanked all the way from $66 down to $19 years ago. They tanked because Disney and Apple decided to become video streamers, and then we got into a massive economic meltdown. Then it just turned out the new streaming competitors did not actually matter to Netflix dominance at all, and the stock eventually shot all the way up past $120 and beyond. And that exact irrational category is where I think we are right now, with a company like Salesforce. Your entire job is a strict rule. One investor in this chaotic moment of artificial intelligence is to sort companies. You must sort each software company into one of those three specific buckets. Did artificial intelligence cause a structural, temporary, or completely irrational repricing of this specific business? You get that one question right, and you do not need to predict the entire future of artificial intelligence. You just need to recognize a durable, cash-generating competitive moat when you see one. So let me make this incredibly concrete for you, because I hate abstract financial theories. I want to walk you through one specific company in this current tech wreckage. This is absolutely not a financial recommendation to buy, you guys, so do not sue me. This is just a real-world example of how a real value investor thinks about numbers. So here's the basic setup for Salesforce. Salesforce is the absolute dominant system of record for how most of the developed corporate world manages its customers'. Enterprise sales teams are tracking every single multi-million-dollar deal inside of it. Global marketing teams are running their entire digital campaigns directly out of it. Customer support teams literally live inside the software 8 hours a day. If you work in a mid-size or large global business, your entire company revenue engine runs through Salesforce. Now, here is the current narrative fear driving the stock price down. Wall Street thinks artificial intelligence agents will eventually match what Salesforce does faster, better, and way cheaper, or at an absolute minimum. Artificial intelligence will collapse the total number of employee seat licenses that companies need to buy. Fewer employee licenses means lower corporate revenue, which means completely crushed earnings for shareholders. Now, that is the official bear case from the smart analysts, and it is not completely crazy on the surface. But here's exactly what Charlie Munger would tell you to do in this exact situation. Always invert the problem to find the truth. Instead of asking how could Salesforce win this tech war, ask a completely different question. Ask what would it actually take for Salesforce to lose its dominance and actually die as a company, well, to kill it completely. A corporate enterprise customer would have to rip out the central nervous system of their business. They would have to migrate decades of proprietary, highly sensitive customer data to a new platform. They would have to completely retrain thousands of angry employees on a new software system. They would have to manually rebuild every single internal software integration they have created over 20 years, and they would have to blindly trust that a brand new artificial intelligence agent will not hallucinate or drop data. They would have to bet their entire business revenue on an unproven technology just to save a few bucks. Picture yourself right now as a corporate vice president of sales who champions that massive software switch. What is your absolute maximum upside? If the risky switch actually works perfectly, you have modestly lower customer relationship management software costs for the quarterly budget. But what is your absolute downside if the new artificial intelligence system fails or drops customer leads? Oh well, you completely blow your quarter. You ruin your entire fiscal year. Maybe you destroy the whole business, and you will for 100% certainty get fired and escorted out of the building. Now, that terrifying downside is what a massive software switching cost looks like in the real world. And that massive switching cost is a beautiful, durable corporate moats built on deeply embedded daily employee workflows. Do not crumble in 12 months because a new technology arrives at the absolute worst case scenario. These enterprise moats tend to slowly erode over a decade, if at all. So here is the massive financial disconnect that I was talking about that is hard to believe. Since its 24 highs, the Salesforce stock price has been cut completely in half by the market. The price to earnings ratio has collapsed all the way from 100 down to a meager 22 price to earnings ratio for a dominant monopoly software company is wild. What that low valuation implies is that Mr. Market is expecting this business to grow at only 10% a year. But if you actually look at the financial statements from last year, net earnings grew 20%, operating cash flow grew 16% year over year. Free cash flow grew 15% during the same period. Book equity plus grew at a beautiful 15%. So, let us do the basic math here. You guys, the stock is priced for 11% growth or worse on a business with an incredibly deep switching moat, and that exact business is currently growing its actual cash flows at 15 to 20%. Now that beautiful mismatch is exactly what a real gap looks like between price and value in an industry sell. Often that is the exact moment Mr. Market is smelling fake smoke in a crowded theater that is not actually on fire, and all the panicked Wall Street lemmings are running blindly for the exit door. Now, it is very important that you hear me on this. I am absolutely not telling you to buy Salesforce stock today. That is not what this video is about, and that is not how we play this game. There are still totally legitimate questions about how artificial intelligence reshapes the tech landscape over 10 years. And you should always take the institutional bear case incredibly seriously before risking your capital. Charlie Munger said it so beautifully. You must know the opposing argument better than the people who are making it. And that deep objective understanding is exactly how you avoid losing your hard-earned money in the stock market. What I am telling you to do is change your entire mindset when these market crashes happen. When an entire industry gets repriced because of pure macro fear, your job is not to run with the panicked herd. Your job is to calmly look at each individual company inside the wreckage and ask three simple questions. Is the competitive moat fully intact? Or is it actually breaking down structurally? Are the underlying corporate financials still incredibly strong? Or are they deteriorating on the balance sheet, and is the current market price now sitting well below what the business is actually worth intrinsically? And when all three of those beautiful things line up perfectly, you get a special situation. You get a real durable moat, really good historical financials, and real market fear dragging the price down. That is exactly when you lean in as a real investor. You do the hard homework, you look at the raw numbers, and you make up your own damn mind. God, that independent mindset is so incredibly key to this whole wealth building game. Because as Warren Buffett and Charlie Munger have said many times publicly, Wall Street can make witch doctors look competent. Their short-term consensus opinion is absolutely not automatically better than yours. In fact, since you have the luxury to think in 5 to 10-year periods, or even multiple decades, and those institutional fund managers can think only in 90-day quarters to save their jobs, you have a massive structural edge in chaotic market moments. Exactly like this one. Look at the reality, you guys. In moments like this, an entire high-quality industry goes on a massive garage sale, and nobody can tell the true winners from the temporary losers on Wall Street because they are panicking. And that exact market confusion is why the Rule 1 investing framework exists in the first place. This is exactly when a rigorous investing framework earns its keep and makes you rich. If you want to learn how to read a corporate moat like a professional analyst, or if you want to learn how to pressure test a balance sheet and spot hidden red flags, or how to calculate exactly what a business is actually worth, using cold hard math, how to set your personal buy price with absolute mathematical confidence, or how to safely use options to begin creating consistent cash flow from your capital immediately, that is exactly the type of practical execution we teach in our 3-day online intensive workshop. Over 30,000 real students have now come through this exact training program, so do not take my word for it. Go take a look at our 4.8 Trustpilot score online. The real student feedback has been absolutely incredible, you guys. And if that sounds like the exact financial skill set that you want to possess when the next industry sell-off shows up, because let us be honest, there is always going to be a next market crisis around the corner. Go ahead and check the private link in the description below, or scan the big QR code right here on the screen. And as always, thank you so much for watching the video. You guys now stop staring at the red charts and go play.